for info only, not financial advice. Okay, so today, we're diving into the world of SCHD.
Ooh.
That's the Schwab U.S. Dividend Equity ETF.
Yes.
You've been hearing buzz about some huge changes coming.
Absolutely.
And you want to know what's up, right?
Big time.
So buckle up, because our team here at Channel Vist dug deep to bring you the inside scoop on this ETF shakeup. You're with Channel Vist. This is your analysis.
I'm excited.
Now, for anyone who might not be familiar with the world of ETFs, like maybe you're just starting out, imagine this, okay? You own tiny pieces of over 100 companies,
Wow.
all cherry-picked, because they're known for paying out solid dividends.
I like it.
So that's cash rewards just for holding on to their stock.
Green money.
Yeah. SCHD is all about that steady growth and those sweet dividends,
It's beautiful.
making it a favorite for a lot of investors.
For sure.
But here's where things get really interesting. This ETF isn't static.
Oh, no.
It's like a sports team constantly scouting for new talent.
I like that analogy.
Yeah, so SCHD goes through a reconstitution every year on the third Friday of March, which means it's happening on March 21st this year.
Coming up?
Which companies might get cut from the team? Who are the rising stars they might bring in? And most importantly, what does all this mean for your investments? Stick around to find out. You won't want to miss this.
No, you won't.
So to understand why this reconstitution is such a big deal, we need to look at SCHD's track record.
For sure.
This ETF has been a bit of a sleeper hit,
It has.
delivering an average annual return of over 11%.
That's right.
That's right. It's kept pace with the S&P 500, but with way less volatility.
It's crazy.
Okay, hold on.
Yeah.
Over 11% average return. That's amazing.
It's incredible.
How have they managed to pull that off?
Well, it all boils down to their super selective process.
Oh, yeah?
They don't just pick any company that pays dividends. No, no, no.
Right.
They're looking for companies with a long and consistent history of dividend payments, a strong track record of growth, and solid financials. They're like the talent scouts of the investing world, always on the hunt for the best of the best.
So they're not just chasing after the flashy high-growth companies.
Nope.
They're looking for the reliable, steady performers that can go the distance.
Exactly.
It's all about sustainability.
That's what it's all about.
Exactly. And to make sure they're picking the right companies.
Right.
SCHD uses 4 key rules.
Like a checklist, yeah.
Ooh. This is like getting a peek behind the curtain.
Behind the scenes, yeah.
What are these 4 secret ingredients to SCHD's success?
All right, so first thing they look at is the free cash flow to total debt ratio.
Okay.
Now, this might sound complicated,
Uh-huh.
but it's basically a way to measure how much money a company has left over after paying all its bills and debts.
Gotcha.
A higher ratio means the company is financially strong and has plenty of cash on hand to pay those dividends.
It's like making sure the company has enough money in the bank to cover its expenses and still has some left over to share with its investors.
Yeah, you got it.
Okay, what about the second factor?
The second factor is return on equity.
Okay.
This tells us how efficiently a company is using its money to generate profits.
Uh-huh.
A higher return on equity means they're making their money work hard for them, which is a good sign for investors.
So they're looking for companies that are smart with their money and know how to turn a profit.
Yes.
Makes sense. What's the third factor they use?
The third one is something we all love.
Ooh.
The indicated annual dividend yield.
Yeah.
This is essentially how much dividend income you can expect to get for every dollar you invest.
Ah, yes. The juicy dividend payout. That's what we're all here for, right?
You got it.
Yeah.
But remember, it's not just about chasing the highest yield.
Right.
We need to make sure those dividends are sustainable, and that's where the fourth factor comes in.
Okay.
The 5-year dividend growth rate.
All right, spill the beans. What's this all about?
All right, so it's all about consistency.
Okay.
This factor looks at how much a company's dividend has grown over the past 5 years. A high growth rate shows us that the company is committed to increasing its dividend over time, giving you that peace of mind that the income stream will keep flowing.
So it's like finding a company that's not only generous with its dividends, but also keeps giving you raises.
Yeah.
I like that. But let's get to the really exciting part. The rumors about the upcoming reconstitution. Some analysts are predicting that big names like Home Depot and BlackRock might be on the chopping block. Can you imagine? These are giants. What are your thoughts on that?
Well, it's important to remember these are just rumors for now,
Right.
but it does highlight how SCHD is always evaluating its holdings to make sure they're still meeting those high standards.
Uh-huh.
It's like a coach constantly evaluating the team's performance to stay competitive.
I love that analogy. So who are the potential new recruits?
Mm-hmm.
Who are the companies being whispered about as possible additions to the SCHD roster?
Well, names like Procter& Gamble, DVN Energy, and even ExxonMobil are being floated around as potential additions.
Whoa.
Yeah.
Okay, so let's
Yep.
break down these potential additions and what they could mean for the future of SCHD. But
Don't forget to hit that subscribe button and leave us a comment below. Tell us what you think about these potential changes to SCHD. We'd love to hear your thoughts. Let's break down these potential additions and what they could mean for the future of SCHD.
all right, sounds good.
First up, we have Procter& Gamble.
Yep.
Their household name. Everyone knows them, right?
Boy, yeah,
Known for everything from laundry detergent to toothpaste.
pretty much.
I mean, they seem like a pretty safe bet, right?
Yeah, absolutely. Procter & Gamble is considered what's called a consumer staples company,
Okay.
which means they sell products that people need and use every single day, regardless of what's going on with the economy. Make sense?
So whether the economy's booming or whether we're in a recession, people still need to brush their teeth and wash their clothes.
Right, exactly.
This makes them a very stable and reliable investment, especially for those who are seeking that consistent dividend income.
So they're like the bedrock of a dividend portfolio.
Exactly, yeah.
No matter what happens in the market, people are still going to need to brush their teeth and wash their clothes.
They need those staples, those everyday necessities.
Exactly. And Procter & Gamble has a stellar track record when it comes to dividend payments.
They really do.
I mean, they've been paying dividends for over 130 years.
That's a long time.
And they've increased their dividend for, get this, 67 consecutive years.
It's incredible, yeah.
Talk about consistency.
Yeah, they are the definition of a dividend aristocrat.
67 years in a row. That's longer than I've been alive.
Yeah.
So from a dividend perspective, Procter & Gamble seems like a slam dunk.
It really does.
But what about growth? Are they still innovating, expanding their business?
Oh, absolutely. They are constantly investing in research and development to create new products and improve existing ones.
Okay.
They're also expanding into new markets around the world, which helps them grow their revenue and profits.
So they're not just sitting back and collecting dividend checks.
Oh, no, not at all.
They're actively working to grow their business and create value for their shareholders.
Exactly. That's what makes them such an attractive investment.
Right.
Especially for an ETF like SCHD, they really tick all the boxes.
Oh.
Strong financials, consistent dividend payments, and a commitment to growth.
All right, so Procter & Gamble is looking like a really strong contender for the SCHD roster.
It seems like it, yeah.
But now let's talk about DVN Energy.
Okay.
They're an oil and gas company, which is a little bit of a different beast
It is.
compared to consumer staples like Procter & Gamble.
Yeah, for sure. DVN Energy operates in what we call a much more cyclical industry,
Okay.
meaning their performance is heavily influenced by factors like oil and gas prices, which can be quite volatile.
Right.
So, those prices go up, the profits go up, prices go down, their profits tend to go down.
Right.
So this adds kind of a different dimension of risk and potential reward to the SCHD portfolio.
So investing in DVN Energy is a little bit more of a gamble,
It can be, yeah.
but it could also lead to bigger gains if energy prices continue to rise.
Potentially, yeah.
All about balancing risk and reward.
Absolutely. That's the name of the game in investing.
Exactly.
And SCHD is going to have to carefully consider these factors when making their decision.
Uh-huh.
DVN Energy has been generating really strong cash flows. They've been increasing their dividend.
Okay.
But the question is, can they sustain this performance in the long run?
Right. Yeah, that's the million-dollar question with energy companies, right?
Exactly.
It's a tough call. What do you think, listeners?
Yeah.
Are you excited about the prospect of an energy company joining the SCHD lineup? Or are you a little bit concerned about the potential risks? Let us know in the comments below. We'd love to hear your thoughts.
Absolutely. Share your opinions.
Now, the third company that's been generating a lot of buzz is ExxonMobil,
Yes.
another oil and gas giant.
Mhm.
This one's even more intriguing given the growing focus on ESG investing.
ESG, yeah.
ExxonMobil is a behemoth in the energy sector,
It is.
but they've also been facing increasing scrutiny
Yeah.
for their environmental impact.
Of course, that's a big topic these days.
Yeah, ExxonMobil has been called out for its role in climate change and its slow response to the transition to renewable energy sources.
Right.
So how does a company like that even get considered for an ETF like SCHD, which emphasizes responsible investing?
Well, it all comes down to SCHD's selection criteria.
Okay,
Remember those 4 factors we talked about earlier?
I do.
ExxonMobil actually scores quite well on those metrics.
Really?
Yeah.
So even though they have a questionable environmental track record, they still meet those financial and dividend requirements.
They do, and that's the dilemma. ExxonMobil is kind of a classic example of the tension between financial performance and ESG considerations.
Yeah.
On the one hand, they're a highly profitable company with a long history of paying dividends, but on the other hand, their environmental impact raises serious concerns for many investors.
So it's a tough balancing act for SCHD.
It is.
They have to weigh the potential financial gains against the potential reputational risks
Exactly.
associated with including a company like ExxonMobil in their portfolio.
And this decision could have major implications for SCHD's image and its appeal to investors who really prioritize those ESG factors.
Right.
It's a decision they won't take lightly.
It'll be interesting to see what they do. Welcome back to the Deep Dive. We've been on the edge of our seats waiting to see how this SCHD Reconstitution would shake out, and now the moment of truth has arrived.
The results are in, drum roll please.
Oh, I'm so excited.
And there are some definite surprises.
Ooh, I like surprises.
Get this. Okay, Home Depot is out. They just weren't meeting SCHD's criteria for dividend growth, which is a major factor in their selection process.
Wow. I knew it was a possibility, but it's still a shock to see such a big name get dropped.
It is. It's a big deal.
It really shows how committed SCHD is to maintaining its high standards
Absolutely.
and delivering consistent dividend growth for its investors.
That's what it's all about.
What about BlackRock? Were they kicked off the team too?
You know what? BlackRock actually managed to hold on,
Oh, okay.
but they're definitely on watch.
I see.
Their performance will need to improve if they want to stay in the SCHD lineup next year.
Yeah, they're on thin ice.
It's a high-stakes game, and only the strongest dividend players survive.
This is insane. You won't believe it. No room for sentimentality when it comes to building a winning dividend portfolio.
You gotta be ruthless.
So who are the newcomers? Did any of the rumored companies make the cut? Tell us.
Okay, so as we predicted, Procter & Gamble is officially in. They're a fantastic addition to the portfolio, bringing stability, a long history of dividend growth, and a commitment to innovation.
I love it.
They're the kind of company that can anchor a dividend portfolio for years to come.
Solid, solid.
What about DVN Energy? Did SCHD decide to roll the dice and bring an energy company into the mix?
Yeah, I'm really curious about that one.
Well, they did. DVN Energy is officially part of the SCHD lineup.
Whoa, that's a bold move.
It's a bold move considering the inherent volatility of the energy sector, but it also presents a significant opportunity for growth if energy prices continue to rise.
Sure.
It's a calculated risk that could pay off big time for SCHD investors.
I guess we'll have to wait and see how that plays out.
Yeah, for sure.
But the real cliffhanger here is ExxonMobil.
Right.
Did they manage to squeeze into the SCHD portfolio despite the ESG concerns surrounding their environmental impact?
This is where things get really interesting.
Okay, I'm all ears.
Despite meeting the financial and dividend requirements, SCHD ultimately decided to pass on ExxonMobil. It seems they weren't convinced that the company's commitment to sustainability aligned with their, increasingly stringent ESG criteria.
Wow, that's a powerful statement from SCHD.
It is.
It shows they're not just paying lip service to ESG.
Nope.
They're willing to make tough decisions and forego potential profits to uphold their values and meet the growing demand for sustainable investments.
Yeah, they're putting their money where their mouth is.
What are your thoughts on all this? Are you surprised by SCHD's decision to exclude ExxonMobil? Let us know in the comments below. You're with Channel Vist. This is your analysis.
It's a bold move that really signals a shift in the investment landscape.
Yeah.
ESG factors are no longer just a niche concern, they're becoming mainstream. And SCHD is positioning itself at the forefront of this movement.
It's a fascinating development that raises important questions about the future of investing.
Absolutely.
As ESG considerations become increasingly intertwined with financial performance, how will companies adapt? And how will ETFs like SCHD continue to evolve to meet the changing demands of investors?
These are questions we'll be exploring further in future deep dives, so make sure to subscribe to our channel.
Yes.
And hit that notification bell so you don't miss out on any of our upcoming analyses.